Compound interest is often introduced as a mathematical formula, a curve on a chart, or a line in a textbook. That explanation is technically correct and practically useless. The financial books that have endured for decades approach compound interest very differently. They treat it not as a calculation, but as a behavioral force. Compound interest rewards patience, consistency, and restraint, and punishes interruption, impatience, and ego. This is why so few people benefit from it meaningfully, even though almost everyone understands it intellectually. In The Richest Man in Babylon, compound interest appears without equations. Instead, it is described as gold that begets gold. The lesson is simple money that is protected and put to work will multiply, but only if it is not consumed prematurely. The book's insistence on paying yourself first is not about saving for its own sake. It is about ensuring that capital survives long enough to compound. Babylon teaches that compounding is fragile in its early stages. The first coins matter more than later ones because they create the base upon which time can operate. Spend too early, and the chain is broken before it begins. The intelligent investor deepens this idea by explaining why compounding fails in real markets. Benjamin Graham observed that investors interrupt compounding through emotional behavior. Panic selling during downturns, overconfidence during booms, and constant strategy changes reset progress repeatedly. Graham's concept of margin of safety exists largely to protect compounding from human error. He understood that a lower return compounded steadily will outperform a higher return that is interrupted by losses. Compound interest, in Graham's view, belongs to those who can stay invested without self-sabotage, not those who chase the highest theoretical return. In The Psychology of Money, Morgan Housel reframes compound interest as a test of endurance rather than intelligence. He points out that Warren Buffett's wealth is not primarily the result of superior stock picking, but of extraordinary longevity in the market. Buffett started early and avoided catastrophic mistakes. Housel emphasizes that compounding does not require brilliance. It requires time without interruption. This insight is critical. Many people assume they need to earn more or invest better to benefit from compounding, when in reality they need to stop doing the things that reset it. Lifestyle inflation, leverage, panic, and impatience. The Millionaire Next Door shows compound interest at work in ordinary lives. The book's data reveals that most millionaires did not earn extraordinary returns. They saved consistently, reinvested quietly, and avoided conspicuous consumption. Their wealth grew because compounding was allowed to operate for decades without disruption. This book makes an uncomfortable point. Compound interest favors those who are willing to look ordinary for a very long time. Visibility status and comparison often require spending that interrupts compounding. The wealthy next door chose invisibility over applause, and time rewarded that choice. Another recurring lesson from financial books is that compound interest applies to behavior, not just money. Habits compound. Discipline compounds. Knowledge compounds. In Atomic Habits, while not a finance book, the principle is identical. Small actions repeated daily create exponential outcomes. Financial books echo this idea implicitly. Saving a small percentage consistently matters more than saving a large percentage sporadically. Investing monthly matters more than timing the market occasionally. Compounding is the accumulation of consistency. Part 1 therefore establishes a critical reframing. Compound interest is not a trick you apply to money. It is a relationship you maintain with time. It works slowly, quietly, and unevenly. Most of its power is invisible for years. This invisibility is why people abandon it. Financial books that teach compound interest effectively do not try to make it exciting. They try to make it survivable. And it is precisely here, when compound interest is understood, as something that must be protected from human behavior, rather than accelerated by cleverness, that its deeper lessons begin to emerge. And the story is not yet complete, because once compound interest is understood conceptually, the real challenge becomes living in a way that allows it to work. Part 2 focuses on why compounding fails for most people, despite being widely understood, and how financial books consistently warn against the behaviors that quietly destroy it. The most common enemy of compound interest is impatience. Compounding feels slow at the beginning and powerful only near the end. This creates a psychological gap where effort is required, but reward is invisible. Financial books repeatedly show that people abandon compounding during this gap. They withdraw investments, chase faster returns, or spend early gains. Each of these actions resets the clock. Compound interest does not forgive resets. Time lost is never recovered. This is why books emphasize starting early and staying consistent rather than optimizing returns. Another enemy is lifestyle inflation. As income rises, spending tends to rise with it. This prevents surplus capital from accumulating, which is the raw material of compounding. The Millionaire Next Door demonstrates that many high-income households never benefit from compound interest because nothing is left to compound. Financial books warn that compounding requires restraint long after earning capacity increases. Without restraint, income growth creates comfort, not wealth. Volatility intolerance is another critical failure point. Markets fluctuate. Compounding requires staying invested through those fluctuations. Financial books consistently show that missing just a few periods of recovery dramatically reduces long-term returns. Panic selling breaks compounding more effectively than low returns ever could. This is why Graham emphasized policy, why Housel emphasized temperament, and why Buffett emphasized staying within one's emotional limits. Compounding rewards those who can endure uncertainty without reacting. Financial books also warn about leverage, which accelerates outcomes in both directions. While leverage can increase returns, it also increases the risk of ruin, which permanently ends compounding. The history of finance is filled with examples of people who understood compounding perfectly and still destroyed it through leverage. The lesson repeated across books is clear: compounding thrives on survival, not on maximum exposure. A modest return that survives compounds infinitely better than a high return that ends abruptly. Another subtle but powerful lesson is the importance of defining enough. Without a stopping point, people increase risk as wealth grows, chasing more even when they already have sufficient security. This behavior often leads to catastrophic loss late in the game. The psychology of money emphasizes that many financial disasters occurred when people risked what they needed for what they wanted. Compounding works best when it is no longer pressured to prove anything. Contentment protects compounding by removing the urge to gamble progress. Perhaps the most important lesson from financial books is that compound interest requires identity alignment. People who benefit from compounding see themselves as long-term investors, savers, or stewards of capital. Their behavior reinforces that identity daily. Those who see investing as a game, a competition, or a shortcut struggle to maintain consistency. Identity determines whether compounding is allowed to run uninterrupted or constantly reset. When Part 1 and Part 2 are combined, a clear truth emerges. Compound interest is simple, but it is not easy. It demands patience in a world that rewards speed restraint, in a world that encourages consumption, and humility in a world that celebrates confidence. Financial books that teach compounding successfully do not promise excitement. They promise durability. And this is where the story ultimately settles. Compound interest is not something you use. It is something you respect. Those who respect it structure their lives to protect time, capital, and behavior from disruption. Those who do not understand this treat compounding as a formula and are surprised when it fails them. The enduring lesson from financial books is that compound interest is one of the most powerful forces in finance, but only for those who are disciplined enough to let it work quietly, patiently, and uninterrupted over the long arc of a life.